Hey traders, I wanted to make a quick little video here on one of the simplest option trades that we do, which is one of my favorite option trades to do, and it is one of the most basic straightforward option trades that you can do, but it tends to cause a lot of confusion in our trading room. So let's give it a go. All right, let's get into this. So, one of the things that I get told a lot from our members in our trading room is that one of my strengths is I do a really amazing job of explaining very complicated trades, breaking down something that's very complicated into something that's very simplistic and something that even a brand new novice trader can understand. Apparently, I don't do that very well with this trade because we've gone over this trade so many times in our trading room and we still get the same questions over and over again. And to add insult to injury, it is the simplest options trade you could ever possibly do. It is the very first options trade that anybody learns. It's the most simplistic to understand, and yet we get the most questions, and it is one of the more challenging trades to get your head wrapped around. And it's a covered call. It's simply a covered call trade, but it's inverted. Okay, it's inverted. So it is instead of going long something and covering it with a call, we go short something and we cover it with a put. Okay, so let's just talk about this. The reason that this is coming up is that we did one of these right now here today at the close on MES. So you can see here I went short 2 contracts of the MES, and then I covered it right here at the money, which is now in the money, but I covered it at the money with 2 contracts of the puts at 39.20. Sold those basically at the money, brought in about $300. So this is about a $3,000 trade that we did, and it is about a $300 income potential. So it's got about 10% income potential, okay? But let's talk about what it is and see if we can understand this a little bit better. So let's go use a ticker symbol that we don't have in place right now. Let me get this keyboard out of the way. I don't know, let's just try IBM. Let's use IBM. We don't have a trade going on in IBM. You guys get how this would work, right? If I wanted to go, let's go look in the curve here. If I wanted to go buy IBM, let's say 100 shares. I wanted to go buy 100 shares of IBM. Let's get that loaded up here. There we go. So you guys understand this risk graph, and I think that this makes sense to everybody. If we bought 100 shares, we're looking to buy 100 shares of IBM here. First of all, it would be about $13,265, but we would use margin. And so, we'd only have to come up with half of that amount. That's what our buying power effect would be, right? We'd have to put up half the money. And you can see that the max loss is $13,265, meaning, well, how low can IBM go? Well, it can go to 0, right? Technically. So technically you have every penny at risk when you buy stock of any kind, right? How low can any stock go? 0. So our risk is everything that we put into the trade. What's our max profit? Well, that little numerical number right there that looks like an 8 on its side is infinite, right? Technically, this stock can go up unlimited amounts. There is no cap on how high IBM can go. So both of these numbers are correct mathematically. My maximum profit on this trade is unlimited. My maximum risk is every penny I put into the stock, $13,265. We know in reality probably both of those numbers are not accurate, right? Probably not a good chance that IBM is going to go bankrupt, at least in the time frame that we're going to be trading it, which might just be a few weeks, right? And there's also probably not a chance that the stock's going to go up unlimited amounts, right? So what we would like to do here is say, look, I can see that this trade has some potential, right? If IBM goes up, I make money. If IBM goes down, I lose money. But what are the chances of this trade working for me? Statistically speaking, what are the probabilities of me making money with this trade, with buying 100 shares of IBM? Well, the statistical probabilities are 50%, right? And that's a real number. It's a 50% statistical I'm having problems with that word. Statistical probability that we make money on this trade, right? Basically, it's a coin toss. Hey, look, we buy IBM today. Tomorrow, it's either going to go up or go down, right? But those are the only two things it can do. So we do have a, statistically speaking, 50-50 shot at this trade working. So what if we said, listen, I want to do something with this trade. You know, I understand it's got unlimited profit potential, right? I don't really buy into that. I don't think IBM's going to go up unlimited amounts. I would be willing to maybe give up some of this upside up here for maybe some certainty. See, this trade is all opportunity, it's all possibility, and no certainty. I'd like a little certainty in the trade, okay? And the way that I could do that is I could come in here to my options table. Maybe we go out 30 days, 29 days. Let's go out 29 days here. And you can see IBM right now is about $1.33, $133 a share. Let's say that we look at it and we say, okay, well, here's this brown bar right here. That's the expected range. And it looks like it might have the potential to go up to 141. I don't know if it's going to do that, right? It's 133 right now. What if we said, look, if it went from 133 to 138, it's $5 profit per share. We've got 100 shares here. It's a $500 profit on a $6,600 margin requirement. That's a pretty good, what is that, 7-8% return? I'd be happy with that, okay? So what if I were to cap my profit at $138 a share? And I would cap it by selling this covered call right here. We call it a covered call because it is covering the shares that we own, right? We own 100 shares, so it's a covered trade. If it was an uncovered trade, it would be called a naked trade, right? But this is covered because we own the 100 shares. So now, if we look at our risk graph, you can see we have, in fact, capped our profit potential at 138. Doesn't matter how high IBM goes. IBM could go to $1 million a share. The most we're going to get out of it is 138. Okay, we've made that commitment by selling this 138 strike price call. Now you're like, well, why would you give up that upside potential? Well, because we are bringing in $1.14 per share, 100 shares. We're bringing in over $100 of guaranteed income on this trade. Okay, so, and again, this is over a 29-day period. Let's say that we did that every month. You know, that's $1,200 a year in income on a $6,500 investment. IBM theoretically could never ever go up over the next year. Would you be okay bringing in $1,200 in income that year on a $6,500 investment? It's almost 20% a year in income, right? So I'm okay with that. And you'll also notice that your probability of profit, it's gone up a little bit, hasn't it? It's moved from 50% to 53%. Well, that's because no matter what IBM does, you're going to keep that $1.14 per share. You're going to keep that $114 that you will bring in by selling that call. Okay, so this is a covered call trade. Everybody gets it. Everybody understands it. It's pretty straightforward. Where we have problems and where we're having problems today in our trading room is when I invert all of this. Okay. So by inverting it, what I mean is that we say, you know what? I think IBM's going down. And so I'm not going to go buy 100 shares. I'm going to go short 100 shares. Okay. Now, It's the same trade that I just did, just to the downside instead of the upside, right? We understand how shorting shares works. If IBM goes down, I make money. If IBM goes up, I lose money, right? It's the same capital commitment. I got to put up $6,600 to do the trade. But now you can see that my maximum profit here is $13,200. Where does that figure come from? Well, it comes from the stock going to zero, because that's your maximum profit on a short trade, right? It can't go below zero. That's your best case scenario in a short. So it would be all $13,262 of value here in this trade go to zero. You'd keep that all, right? What's the maximum loss? Well, unlimited, theoretically, right? Because how high can IBM go? Well, theoretically, it can go as high as it wants, right? So again, we know that these numbers are probably not accurate. They're mathematically accurate, but they're not real world numbers, right? Is IBM really going to go to zero? Is my max profit really $13,268? Is IBM really going to have a shot at going to zero in the next 29 days that we're talking about right now? Probably not. Is it going to go up unlimited amounts? Well, it never has. No stock ever has. GME, meme stocks never have. Nothing ever goes straight up forever, right? So neither one of these numbers is probably accurate. But again, the problem with this short trade is that statistically speaking, I've got a 50-50 chance of being right. 50% probability. Look, I short these shares today. Tomorrow, IBM's either going to go up or down, right? 50-50 shot. So again, how could I add some certainty into this trade? Well, once again, what if I came in here and said, look, there's a lot of possibility, there's a lot of opportunity in this trade if I'm right, if IBM does go down, but there's no certainty, right? What could I do to potentially add some certainty into this trade? Well, I could cover this. I could say, look, I'm going to give up some of this unlimited profit potential down here for some guarantees, for some certainty. So again, I could come back into my options table here. We're out to these June 10th options. They're 29 days out into the future. We know that the stock's trading around 133 right now. What if I said, look, I don't think this thing is, I think it's going to go down, but I don't think it's probably going to go down below $124. I could sell one of those options for $1.38 a share, times it by 100, that's $138 of income, right? The minute I click that button, I get $138 deposited directly into my brokerage account. It's real money. It's my money. I can do with it what I will, but it's not free money, right? Because by selling that put for $1.38, I have committed now that this is my max profit on the downside, right? I will have to buy that stock back. Someone has the right to put the stock to me at $124 a share. So what if it crashes all the way down to 110? Doesn't matter, does it? I'm going to have to buy it back at 124. So that's my max downside profit potential. You say, well, why would you do that? Well, because I'm bringing in $138 of guaranteed income on this trade, right? So again, you know, what is that? I don't know, $1,400, $1,500 a year of guaranteed income potential over a 12-month period of time on a $6,500 investment. It's pretty good cash flow, right? And what does it do to our probability of success? Well, it raises it, doesn't it? Obviously, that makes sense. If you have guaranteed income coming in, no matter how small that income is, it's going to give you an edge. We talk about that all the time in our trading room, doing something that gives you an edge. If you're shorting something, if you're buying something, maybe you're right, maybe you're not, but there's no edge in that, right? There's no edge. It's a 50-50 shot. So in this case, we do have an edge. So this is all we're doing here. This is a covered call trade, just inverted. Instead of buying a stock and going going long a stock and covering it with a covered call. We're going short a stock and we are covering it with a covered put. Now, back to the trade that we did right here with the MES. People get tripped up for two reasons. Number one, it's on the MES, which is the micro futures contract for the E-minis. Guys, it doesn't matter what it is. We do these on corn and wheat and oil and soybeans and natural gas and oil. It doesn't matter what the underlying is. The risk-reward graph is going to look exactly the same. The risk-reward graph is going to look exactly the same. Okay, this is our MES trade right here. You can see that I'm short two futures contracts right here. That's what that implies right here. I'm short two futures contracts. And then I've covered it right here almost exactly at the money. Okay. Now, we don't need to get into the technicals of this. Suffice it to say that 32.90 has been a big technical resistance support level for the E-minis over the last few days. That's why I picked this level. That's why it allows me to have profit all the way up to that level. But basically, this is all we're working on right here. Anywhere in this green area tomorrow, because these options expire tomorrow, May 13th. Today is May 12th, and Friday, tomorrow morning, this is coming to expiration. Anywhere in here will finish in the profit zone. Again, it's about a $3,000 trade. You can see right there, my max profit at expiration is about $300. About 10% profit potential on the trade in a one-day period of time. The E-minis right now, or the micros if you will, are at 39.17. They've got to stay below 39.50 by the end of business day tomorrow for this trade to finish in the money. What happens if it doesn't? What happens if the micros go above 39.50? Well, I could just come in here on this contract that I've sold. See, I'm going to get this $292. That money is mine. Regardless of what happens with that trade, I keep that money, right? So I could, let's say that it doesn't work, I could roll this out to next week, right? Get this out of the way. I could roll this out to next week's expiration. That's 5/20. And you can see that that brings in, if we left it at the same strike prices, it brings in another $435. Are you willing to put up about $3,000 a week to bring in $400 a week in income? $3,000 for a chance to bring in almost $1,600 a month, $400 a week. That's about $1,600 a month. I'll put up $3,000 to bring in potentially $1,600 a month in income over a 1 month period of time, especially in a bear market like we're in right now. And this is a trade that makes us money in bear markets, right? This is a little bit of a tangent. This is a little bit off of the topic here, but obviously the market's crazy right now, right? We are 16 trades into the week, this week, in our trading room. Tomorrow will be another 0 DTE day. We very well could have as many as 22 trades to end the week. So far, knock on wood, all 16 of our trades through today, through Thursday, from Monday till today, all 16 of our trades have been profitable trades. Every one of them. There's two reasons for that. One, the strategies that we use. You got to use the right strategies at the right time. This is a great market to trade. This is a fantastic market to trade, but it's a bearish market. So if you're trading bullish strategies, good luck with that, right? So trade the right strategies. Number two, trade it on the right underlines. You can see stuff that we're trading in here right now. There's wheat. There's oil. Most of these tickers are pairs trades. Pairs trades don't care. It doesn't matter what the market does. Market can be up 800 points or down 800 points. It doesn't affect a pairs trade. There's soybeans. There's the yen trade. There's a bond trade. There's a natural gas trade. And there's a short on a index trade, on a futures index trade. All of these things are in the markets, but not of the markets. None of these trades need the stock market to go up to make money. So hopefully that is a good explanation for those of you that don't understand a covered call that's just simply inverted, which is shorting and selling a covered put. Hope that helps, guys. Take care.